What's happening, crypto crew? Get ready to dive into the most explosive updates shaping our digital world. The news cycle is moving at lightning speed, and you're about to get the unmissable intel you need to stay ahead. We've got a major scam alert that could hit close to home. Next up, we're diving deep into market volatility and who's really driving the big moves. Then, we're taking a look at how your paycheck might soon be paid. And finally, we're uncovering a surprising shift in where the smart money is flowing. Don't miss a second, stick around for all the details. You won't want to miss this. Beware the digital deception, a cautionary tale. In a stark reminder of the evolving landscape of financial crime, a recent incident in New Lenox has highlighted the persistent threat of sophisticated scams targeting unsuspecting individuals. A woman, aged 79, fell victim to a cunning phone scam, losing a staggering $37,560 after being coerced into depositing the funds into a Bitcoin machine. This event underscores the critical need for increased awareness and education regarding cryptocurrency-related fraud, particularly targeting vulnerable demographics. The incident unfolded on August 11th when the woman received a call from an individual posing as an agent from a federal department, specifically claiming to represent the United States Department of the Treasury. The scammer employed a common tactic, fabricating a story about compromised personal information and the opening of fraudulent accounts. To resolve this fabricated issue, the victim was instructed to withdraw a substantial sum of cash from her bank and deposit it into a Bitcoin ATM. This method of payment is frequently used by scammers because it offers a degree of anonymity and immediacy, making it difficult to trace or recover the funds once they have been transferred. The woman, evidently convinced by the caller's fabricated authority and the urgency of the situation, complied with the instructions, visiting 3 different Bitcoin machines to complete the transaction, though she could not recall their specific locations. According to the New Lenox Police Department, Deputy Police Chief Tim Perry confirmed the details of the deceptive practices complaint. The Federal Trade Commission, FTC, has frequently warned about such schemes, noting that government impersonation, business impersonation, and tech support scams are prevalent. The FTC explains that scammers create urgent justifications for victims to withdraw cash and deposit it into Bitcoin ATMs. Once a QR code provided by the scammer is scanned at the machine, the cash is immediately deposited into the scammer's cryptocurrency account, effectively vanishing. This particular scam exploits a common vulnerability, the fear of law enforcement or governmental repercussions. Scammers often leverage the perceived authority of official-sounding titles and institutions to instill fear and obedience. The choice of Bitcoin ATMs as the deposit method is also strategic. Unlike traditional bank transfers, which can often be reversed or traced through banking channels, cryptocurrency transactions, especially those initiated through anonymous means like ATMs, are significantly harder to reverse. Once the Bitcoin is in the scammer's wallet, recovering it becomes an arduous, if not impossible, task. The age of the victim also points to a persistent issue where older adults are disproportionately targeted by these types of fraud, due to potential factors like less familiarity with digital currencies or a higher degree of trust in official-sounding communications. The impact of such scams extends far beyond the financial loss. Victims often experience significant emotional distress, trauma, and a sense of violation. The loss of life savings can have devastating consequences on their financial security and overall well-being. The incident serves as a critical reminder for the public to be exceptionally vigilant against unsolicited calls, especially those demanding immediate financial action or the use of unconventional payment methods like cryptocurrency ATMs. Authorities consistently advise individuals to verify the identity of callers directly through official channels and to never share personal or financial information with unknown entities. Independent verification and a healthy dose of skepticism are the best defenses against these pervasive digital deceptions. This is a serious wake-up call about the dangers lurking in the digital currency space. But what does this mean for the broader market? We're about to find out as we look at the latest data on crypto volatility. Market maturation, or a temporary calm. CME reports volatility drop amidst institutional surge. The cryptocurrency market, often characterized by its wild price swings, may be entering a new phase of maturity, according to recent reports from CME Group. The financial giant has noted a significant decline in crypto volatility, a trend that analysts suggest is directly linked to the escalating influx of institutional investors seeking more structured trading environments. This development is painting a picture of a market that, while still susceptible to macroeconomic shocks, is gradually stabilizing and integrating further into the traditional financial system. CME Group's findings indicate that the reduced volatility reflects a growing sophistication in how digital assets are traded, with institutional players bringing with them a demand for predictability and risk management tools. This contrasts sharply with the more speculative, retail-driven volatility seen in previous market cycles. However, the market is far from immune to external pressures. On August 15th, Bitcoin experienced a notable downturn, shedding nearly 7% of its value. This sharp decline was triggered by stronger-than-expected U.S. inflation data, which dampened expectations for an imminent interest rate cut by the Federal Reserve. The sell-off wasn't just a minor dip. It resulted in over $930 million in leveraged liquidations across the crypto market and saw Bitcoin breach the critical support level around $117,500. The U.S. Producer Price Index, PPI, report, showing a 3.3% annual increase, reinforced inflation concerns, leading to a general risk-off sentiment globally. Despite these price corrections, the underlying institutional interest remains robust. CME Group data highlights that derivatives open interest has reached an impressive $32.5 billion, signaling that professional investors and hedgers are actively participating and hedging their positions. This sustained engagement suggests that while short-term price movements can be volatile, the long-term conviction in the crypto market remains strong among institutional players. Furthermore, altcoins have demonstrated a degree of resilience, with platforms like Avalanche and Starknet showing increased liquidity even during Bitcoin's downturn, indicating a broader market strength beyond just the flagship cryptocurrency. Analysts are closely watching upcoming events, such as the $12 billion BTC options expiry scheduled for August 31st. This event carries the risk of renewed price volatility as traders adjust their portfolios. However, the long-term fundamentals for Bitcoin appear solid, bolstered by ongoing regulatory developments and consistent inflows into Bitcoin exchange-traded funds, ETFs, which saw $561 million in inflows in a single week. The active participation of major financial institutions like Citigroup, which is expanding its custody services for stablecoin reserves, and JP Morgan, which anticipates a $500 billion stablecoin market by 2028, further underscores the growing institutional embrace of the crypto ecosystem. JP Morgan specifically notes Ethereum's potential as a major beneficiary, given its significant role in hosting stablecoins. In essence, CME Group's report on declining volatility, coupled with sustained institutional interest and strategic moves by major financial players, suggests a market evolving towards greater stability. While macroeconomic factors will continue to influence short-term price action, the increasing integration of crypto with traditional finance, driven by institutional adoption and regulatory clarity, points towards a more predictable and mature digital asset landscape in the long run. This trend is critical for understanding the future trajectory of Bitcoin and the broader cryptocurrency market. It's clear the big players are making moves, but are they influencing where the everyday user is putting their money? We're about to explore a fascinating shift in how people might get paid next. Beyond the paycheck, Bitcoin's ascent into the payroll paradigm. The financial landscape is undergoing a quiet revolution, and at its forefront is the increasing exploration of Bitcoin as a viable payroll solution. This innovative approach isn't just a niche trend. It represents a potential paradigm shift in how employees receive their compensation, offering enhanced financial inclusion and unprecedented control over earnings, especially for the unbanked and underbanked populations worldwide. As businesses increasingly recognize the advantages of digital currencies, paying salaries in Bitcoin is emerging as a significant development that could redefine employment and financial access. The adoption of Bitcoin for payroll is particularly gaining traction among tech-savvy demographics, including millennials and Gen Z, who are more open to alternative payment methods and are attracted by the potential for wealth growth and inflation hedging that Bitcoin offers. Companies embracing this model are not only appealing to a younger, digitally native workforce, but are also positioning themselves at the cutting edge of financial innovation. In 2025, the trend of incorporating Bitcoin payroll services is expected to grow, allowing employees to receive their wages directly in cryptocurrency, bypassing traditional banking systems and their associated fees and delays. One of the most compelling aspects of Bitcoin payroll is its potential to foster financial inclusion. In regions where access to conventional banking services is limited, Bitcoin provides a practical and accessible alternative for wage distribution. By enabling direct digital payments without the need for a bank account, it empowers individuals, particularly those in emerging markets or engaged in gig and remote work, to participate more fully in the digital economy. This can be transformative for individuals who have historically been excluded from the traditional financial system, offering them greater autonomy and economic opportunity. However, the path to widespread Bitcoin payroll adoption is not without its hurdles, chief among them being regulatory complexities. Governments globally are still grappling with establishing clear and comprehensive regulatory frameworks for cryptocurrencies. Businesses looking to implement Bitcoin payroll must navigate a complex web of compliance requirements, which can vary significantly by jurisdiction. Initiatives like Europe's Markets in Crypto Assets Regulation, MiCA, aim to standardize rules, but the cost and complexity of compliance can still be a barrier, especially for smaller enterprises. Staying abreast of evolving regulations and ensuring full compliance is crucial to avoid legal pitfalls. Technological advancements are playing a pivotal role in making Bitcoin payroll solutions more feasible and scalable. The development of the Bitcoin Lightning Network, for instance, facilitates faster and cheaper transactions, addressing some of the scalability concerns associated with Bitcoin's main blockchain. These innovations make microtransactions and regular salary payments more practical. Furthermore, the inherent security and transparency of blockchain technology provide a robust foundation for payment systems, instilling confidence in both employers and employees. As more companies explore and adopt these solutions, the demand for reliable and user-friendly crypto payment platforms is set to surge, further driving innovation in this space. Looking ahead, the future of payroll is likely to involve hybrid models. Companies may offer employees the choice to receive their salaries in a mix of Bitcoin, stablecoins, and traditional fiat currencies. This approach allows businesses to mitigate the price volatility associated with Bitcoin while providing employees with flexible payment options that suit their financial needs. As regulatory clarity increases and specialized crypto payroll platforms mature, the adoption of Bitcoin payroll is expected to accelerate across various industries, potentially reshaping the employment landscape and establishing cryptocurrency as a mainstream payment method for salaries. So, getting paid in crypto could be the next big thing. But where is all the money going when Bitcoin isn't the main attraction? We're tracking a surprising shift in investor focus right now. Bitcoin's fading grip. Retail investors eye altcoins as momentum shifts. Bitcoin, the undisputed leader of the cryptocurrency market, appears to be experiencing a notable loss of momentum, prompting a significant rotation of investor capital towards altcoins. After scaling peaks that surpassed $124,000, the flagship cryptocurrency is showing signs of fatigue, a phenomenon that seasoned analysts interpret as classic market behavior often preceding a correction. This shift in investor sentiment is mirrored by a surge in retail interest towards alternative digital assets, most notably Ethereum, signaling a potential inflection point in the current crypto cycle. Several warning signs suggest Bitcoin's current bullish run may be cooling. Max Shannon, a researcher at Bitwise, describes the market as exhibiting classic behavior soaked in foam, a pattern historically associated with buyer exhaustion. This occurs when the volume of buy orders can no longer absorb the selling pressure, creating an environment ripe for a sharp price decline. The Digital Asset Sentiment Index further illustrates this divergence, jumping dramatically from 0.23 to 0.91 in a single week, indicating a sudden surge in optimism that is not being matched by Bitcoin's price performance. Such a gap between sentiment and price action is often viewed by experienced traders as a critical warning signal. Concurrently, retail investor interest is visibly pivoting. Google search trends reveal a significant uptick in queries for altcoins and Ethereum, reaching levels not seen in years. This pattern strongly echoes historical crypto cycles, where a weakening of Bitcoin's dominance often precedes a period of outperformance by alternative cryptocurrencies. The recent drop of Bitcoin below the $117,000 mark further solidifies this fragile outlook. Adding to the market's uncertainty are the contradictory statements from Scott Bessent, a figure associated with the U.S. Treasury, regarding the government's potential involvement with Bitcoin reserves. His initial assurance that no additional purchases were being considered, followed by a swift backtrack, highlights the ongoing ambiguity surrounding the current administration's stance on digital assets. Looking ahead, September could be a pivotal month for altcoins. David Duong, head of research at Coinbase Institutional, anticipates a potential, large-scale altcoin season, a phase characterized by the outperformance of at least 75% of the top 50 cryptocurrencies against Bitcoin over a 90-day period. The Altcoin Season Index, currently at 42, up from 33, is trending upwards, reflecting this renewed interest, even though it remains below the critical 75% threshold. This growing interest in alternatives is also benefiting stablecoins, with major financial institutions like Citigroup actively expanding their strategies to include custody of stablecoin reserves, a market McKinsey estimates at $250 billion. Citigroup's move also positions it to challenge Coinbase's dominant role in crypto ETF custody. J.P. Morgan analysts are particularly optimistic about Ethereum's prospects, noting its increasing dominance in hosting stablecoins, currently accounting for 51% of those in circulation, valued at nearly $138 billion. The bank projects the global stablecoin market to reach $500 billion by 2028. Michael van de Poppe, founder of MN Trading Capital, suggests that altcoins could see gains of 100% to 150% if Bitcoin and Ethereum manage to stabilize their prices. The current weakness in Bitcoin buying activity is also occurring during August, a traditionally slower month for financial markets, which could exacerbate the ongoing correction and accelerate the capital rotation towards altcoins. The battle for crypto supremacy is clearly far from over, with altcoins poised to challenge Bitcoin's reign. It's a dynamic shift, showing just how quickly fortunes can change in this market. Stay tuned as we wrap up with a lightning round recap of today's top stories. And that's a wrap on today's essential crypto updates. We saw a chilling scam targeting a woman in New Lenox, a potential shift in market stability reported by CME, the rise of Bitcoin in payroll systems, and a major rotation of investor interest towards altcoins. Don't forget to like this video if you found it valuable, subscribe to Bitcoin Bulletin for more crucial insights, and hit that notification bell so you never miss an update. Share your thoughts on these stories in the comments below, and make sure to follow us on all social platforms for real-time news. We'll see you in the next one.